All right, so we are talking about incorporation considerations, and clients often ask whether they should include their spouse or their common law partner in their corporation. This single decision can have some awesome tax benefits, and it can also potentially destroy your business. Like a marriage itself, this is an important question and difficult to adjust as time goes on. Changing your mind later can come with a whole host of extra complications. In this video, I'm going to walk you through the things you'll want to consider before taking the plunge. The benefits. Adding your spouse as a corporate shareholder can come with some real benefits. A longtime client of mine had this same question when incorporating their business. Their relationship was a bit on the newer side, and although they really liked their spouse, they were a bit uncertain of the future. After some contemplating, they decided to add their spouse as a shareholder of their corporation. Now, their spouse ended up working in the business and turned into a great asset, bringing skills and perspectives to the table that my client did not possess. Being an owner allowed the spouse to feel more invested in the corporation and help steer the business towards success. In addition to a different perspective and skill set, we could also capitalize on some awesome tax advantages because the spouse was both a shareholder and significantly involved in the corporation. This meant that we could utilize dividend allocation options, being able to declare dividends towards the spouse and taking advantage of a lower tax bracket. When the client eventually sold their business, they could utilize the lifetime capital gains exemption for both themselves and their spouse. This allowed them to double the cash they could take out of their business tax-free. So this is a huge advantage of adding a spouse to a business. Adding a spouse to their corporation was a significant benefit for this business owner and allowed them to save thousands in taxes. But not every business ends up in the same situation. The downsides. Another client of mine started a business with their spouse. Becoming 50-50 owners of a new corporation seemed like a no-brainer. They both worked in their corporation and their business became quite successful. However, it did push their marriage to the breaking point. No clear boundaries were established for roles or responsibilities within the business, and when disagreements broke out, there was no identified individual who could make the final call. Disputes started at work were taken home, and owning a successful business together did not turn into the dream that they had both envisioned. After a rather difficult divorce, the business was in shambles. Incomplete documentation and continual infighting meant thousands of extra dollars both in legal fees and unnecessary taxes. Now, this client is one of many who has struggled with transitioning a former spouse out of the business and moving on successfully after a separation. It can be really difficult if things go south, and removing a shareholder from a business adds not only tax complications but also legal issues. And now this is true whether you are in a marriage, common law relationship, or just friends. So adding and removing shareholders. So why is it so tough to make changes to your corporation structure later on? Well, first, let's talk about adding your spouse. If your business has been quite successful, you add your spouse without any actual money or other consideration changing hands, then a shareholder benefit can be constructed by the Canada Revenue Agency. This could mean a big tax bill, and rather an unexpected one. Now, the second risk is attribution rules. Even though you've added your spouse to your business, the CRA may recognize that this might have been done for purely tax reasons, and they can attribute income you've allocated to your spouse back to yourself as the original owner. This means those lovely tax benefits you were looking for have just gone out the window. So these risks can be mitigated by adding your spouse upon initial corporation rather than later on, and a few other tax things we'll talk about in a minute. Now let's talk about removing your spouse. Removing a shareholder from a corporation can cause deemed dividends to pop up. This happens when a shareholder is removed and can mean thousands of extra tax dollars. Separation and divorce considerations can also mean huge cash draws from a business. This can spike your personal taxes and can get really messy really fast. Now for some good news. There are options for changing a corporation structure after you've incorporated. Things like trust, interest accruing debt, rollover provisions, and estate breaches can all be beneficial. However, these things take time, planning, and significant legal and accounting fees can definitely pop up. So some recommendations. So now that we know what we are walking into, what's the best decision for you? Well, to make the best choice, I would recommend carefully contemplating your relationship, as well as setting clear rules and responsibilities within the business. talking to your lawyer, and consider if a shareholder agreement will be beneficial for times when disputes arise. Next, consider if an individual should have control rather than a 50-50 split. A clear decision can really help things. There is no right answer to this really big question, but talking about the difficult aspects early on can help set you up for success. The right decision isn't one size fits all. Instead, it requires a deep dive into the stability and longevity of your relationship, along with really good communication skills. All right, I hope this video has helped you decide if you should include your spouse or not in your business. That's all I have for today. Bye for now.